Greetings, my name is Kevin Matthews and I am the tax professor. Class is still in session because the learning never stops. Today we're going to kind of talk about a subject called incentive stock options. And I'm going to share a little story with you. So when I got out of the military and I decided that I was going to go and I wanted to, I was going to go back to the CPA world. For those of you that don't know, I signed up after 9/11. I was well on my way to getting my accounting degree. I'd actually done some accounting work, and when I got out of the military, I was like, you know what, I'm going to go back and be a CPA. So I was actually very blessed that I was able to do that. I remember my very first job that I was at. I won't name the firm. You can go find it on my LinkedIn if you're really that desperate to know. But I remember one of the guys that, one of the tax returns that I was doing, a person who received incentive stock options, ISOs as we call them. Or ISOs, as they are also called. And I was kind of, I was perplexed. I was like, what the heck are these ISOs? Of course, being in the military, we never get ISOs. We never get stock options. I mean, wouldn't that be great? And it's almost like kind of like if you remember the Ferengi military, you might get stock options. But I'm sorry, I didn't mean to make a Star Trek reference on here. I hope Roddenberry's group doesn't come after me and try to seek royalties on that. But the fact of the matter is that these ISOs, I had never seen them before. So I remember I had to do a significant amount of research on them. And, it's actually interesting. I remember when I was doing that research on it, I went to the partner who had previously worked at the IRS, and he said, wow, these guys have ISOs. I didn't think anybody was doing ISOs anymore. And there was a reason for that. ISOs have a very, very potentially nasty alternative minimum tax aspect to them. Now, for those of you who are like, well, what's alternative minimum tax? You probably just haven't been hit by it yet. Now, the good news is that under the new tax law, you're more likely not to get hit by it, and that's what we're going to kind of talk about here later on. But I remember, hearing from the partner, he's like, Kevin, I remember I said, do you want me to become like this, instead of, you want me to become the stock options guy? He said, Kevin, you're not going to see ISOs again. And it was kind of funny because after he said that, it was actually very true right up until the passage of this new tax law that went into effect in 2017. And the reason why that happened is, like I said, the thing that really made ISOs very unpopular was the aspect of it, of the alternative minimum tax aspect. And we'll kind of talk a little bit about that today, and how that kind of works out. And people were just like, look, if we're going to get hit by AMT, we'll just go ahead and we'll do different types of stock options, which there are multiple types. We're not going to get into all of them today. So a very good example, say for example, the ISO, it gives you the right to buy 1,000 shares of the company's value stock at fair market value at the time of the ISO grant, which is expected to be about $100 per share for a 5-year period following the grant. So that's kind of the situation that we're going to set up here. The grant to the ISO will not be taxable to you. And some people might say, oh, wait a minute, whoa, hold on a second. You're giving me 1,000 shares, a grant to buy 1,000 shares and it's not taxable to me? Why not? Well, what's the value? Okay. The value is not necessarily readily determinable in this stuff, at least not at the level that would allow for an amount of confidence where you could say, this is how much tax it would end up being. So this is part of the reason why it's not been set up as being taxable. The Congress and the courts have been pretty clear that if there's not a readily determinable amount, they're just not going to go ahead and tax it. And so that's kind of the reason why it worked out the way that it was. Now, so for example, take our example there, like I said, it won't be taxable at grant, but if you later exercise it, you won't be subject to the regular tax as a result of the exercise. For example, if the market value of the stock goes up to $150 a share, so it went from $100 a share to $150 a share, and you exercise and you buy 1,000 shares for the fair market value, you would have bought 1,000 shares at $150 a share. But instead of paying $150 a share, you're only paying $100 a share. So there's that delta of $50 per share at $1,000 bucks. That's like $50,000. Okay, you will not pay any income tax on that $50,000. okay, at that point, at the point of exercise. However, it is an AMT preference item that gets added into your income for AMT purposes. Now, if you sell the stock when it reaches its value of $200 a share, then your $100,000 profit will be taxed in the year of sale. Although the sale is taxable, no income tax will be withheld from your paycheck. Okay. If you want the profit to be taxed at favorable capital gains rates, there's certain rules that you have to apply. But let's before we do this, let's talk a little bit about this. Okay. So you're granted at 100. You buy it at 150, and you later on sell it at $200 a share. It's going to be taxable to you at $100,000 at regular tax. Okay. Now you say, okay, Kevin, but you said there was a portion of this is taxable at the AMT. What happens to that portion when I go and I cash the stuff out? What's going to end up happening is that it's going to be a reversal of the AMT preference item that you paid at the exercise. So, and some of you are probably watching this video going, huh? I didn't understand any of that. And you're probably rewinding this and watching this a couple hundred times before you say, Kevin, I don't understand any of this. This is why ISOs are very difficult. They're not easy to figure out. This is why when I was a brand new staff accountant, I ended up having to take, a couple, 3 hours to figure out every aspect. Now, mind you, this person that we were doing taxes for, there wasn't just one transaction. These were like multiple transactions over multiple years, and we had to go do some research as to whether we could get him, how he was going to be taken care of on some of this and all that stuff. It's just something that we had to do. But just on a basic, simple ISO case, you probably want somebody who understands this stuff. Okay, so talk to a CPA. You want to ask them if they know anything about stock options and how stock options are taxed. A good majority of them who actually don't will say they don't because they don't want to get into the situation where they screw it up and then they're held liable. So, like I say, go to a CPA, EA, or tax attorney, and you can make sure that you get the right person. Now, so you do all of these things, and you say, okay, I've got the, grant at 100, exercise at 150, sell at $200. How do I get the best tax treatment for it? And if you want to get it at favorable capital gains rates, you cannot make disposition of the stock within a 2-year period after the ISO is granted or 1 year after the stock has been transferred to you. So from grant to sale has to be more than 2 years. From exercise to sale has to be more than 1 year. Okay, if your disposition includes sale, exchange, or similar gift or lifetime transfer. If you dispose of the stock before both the required holding periods have expired, then you will have to treat the gain as a premature disposition as ordinary compensation to the extent of the lesser of the stock market's fair market value exercise date, or the amount realized on the disposition minus the basis of the stock. Okay, so what does all that mean? Basically, you don't hit in those 2 gates, it gets ugly. Okay, just leave it at that. And when I say ugly, we're talking ordinary rates. Now, if you're the kind of person who's getting these ISOs, chances are you ain't burger flipping. Okay, you're probably making some pretty good money, and so chances are these ISOs and this idea where you're going to get 1,000. Most of the time that I'm dealing with ISOs with people, at least in the past year, and then way back when, we're talking with people who are getting $5,000 to $6,000 shares worth of stock of ISOs. And I remember one person's, W-2 income ballooned from like $250,000 to over $850,000 in 1 year. This is a significant issue. And the time to talk to somebody about this is not March 15th of the year that you're filing, the year after where you're going to file the tax return. That's not the time to talk to them. The time to talk to them is before you even exercise. Okay, you should be having a conversation with your tax planner and saying, look, I'm about to exercise 2,000 shares of ISOs. What's going to happen? It's not so much that we're going to tell you not to exercise. It's just that we want you to be aware of all your tax consequences before you do so, because, and don't take this the wrong way, but this is like when I was in the Navy and you hand an E3, $100,000 after they come back from deployment. What's the first thing they're going to do? They're going to run out and go buy their first sports car. That's going to cost them $80,000. Okay, you don't want to be that guy who gets, $500,000 and says, hey, I can pay my house off. boom, pay off the house. Well, next thing you know, your taxes weren't being withheld correctly, and as a result of which, now you're going to have to remortgage part of the house in order to get the money so that you can pay the taxes that you had on all this. Okay, if you knew about it up front, you could take that money, and instead of mortgaging and unmortgaging and all that sort of stuff, you could take it, set it aside, or you can pay it to the IRS ahead of time, depending on how things are going. We will recommend which way is best for you. But, you know, we want to give you the options, and you got to work with us here. And contrary to my, I mean, I've been married 15 years, folks. As my wife will attest, if she were standing here right next to me, I can't read minds. Okay, and I guarantee you other CPAs are just like me. So the special treatment for ISOs for regular tax purposes, which is the no taxation of the ISOs until exercise, deferral of tax until the stock, and the taxation of the entire profit of capital gains, aren't allowed for AMT purposes. Okay, so under AMT rules, you must include the bargain element, the difference between the ISO stock value and the lower price you paid for it, in your AMT income. And for most persons, this occurs in the year that the ISO is, for the year that you paid for it in your AMT income, the year the stock becomes freely transferable and isn't subject to substantial risk of foreclosure. For most taxpayers, this occurs in the year the ISO is exercised. What does this all mean for you? It means that if you are subject for AMT, this can get ugly. Okay, and this is one reason why ISOs went and started going the way of the dodo, because people were coming back saying, you want to pay me what? ISOs? No, absolutely not. I've heard that those are nasty. I don't want to deal with them anymore. So now, why are we having this video? Well, here's the thing. In 2017, when the new tax laws got put into effect, they changed the rules. And now AMT is at a much higher level. In fact, I have most of my clients, I think I only had maybe about, we easily had an 80% drop in the number of people who were in AMT compared to those that are in AMT this year. That is substantial. It's phenomenal, in my opinion. And as a result of which, you know, these are no longer as ugly as they used to be. So I could easily see ISOs coming back as a potential compensation item. And just kind of as a side note, here at Beta Solutions, one of the things that I actually specialize in is compensation consulting. I don't, you know, not only am I a CPA, but I'm also getting my doctorate degree in organizational learning. And so we do talk about, you know, compensation from an HR, human resource perspective. And so, you know, I've talked to one person already about the idea of offering ISOs as a compensation item, because I think it's something that's going to be very useful. You know, again, ISOs are very complex. It's something that you don't want to be messing with unless you have the whole thing taken up correctly. So if you have any questions, feel free to reach out to me. If you want to ask just a general question, I can't imagine you would, but if you do want to, go ahead and put it in the comment box below. If you want to ask me something more one-on-one, which I would expect, go ahead and contact me through my website at www.betasolutionscpa.com. That's www.betasolutionscpa.com. And I'd be happy to talk to you about this. Again, if you like these videos, folks, please go ahead and hit like. And then also, if you don't mind, we'd also like you to hit subscribe if you like the video series as a whole. If you have any questions, feel free to reach out to me. Thank you very much.